Okay, welcome. This is an tutorial on how to solve problem E6-4 from your workbook. And I'll read the problem aloud now to give you an idea of what I'm talking about, but I've written it here for your reference. Refer to the Elmo's music inventory data in E6-2, except now assume that the store uses a moving weighted average cost method. Prepare Elmo Music's perpetual inventory record for the guitars on the moving weighted average cost basis. Round average cost per unit to the nearest cent and all other amounts to the nearest dollar. So I'm going to highlight some key words for us here. It says to use the moving weighted average cost basis. This right here. Well, what the heck is that? So let's back up a minute. We know from class that there's 3 acceptable methods from valuing inventory. There's specific identification, FIFO, and moving weighted average. So this is the third of the 3 acceptable methods. E6-2, another video tutorial, we already solved the FIFO method. This is now using moving weighted average. And the way that is calculated is by taking the total cost of all inventory items purchased and dividing it by the number of inventory items we have on hand. So what I'll do is I'm going to make us a little cheat sheet here. I'm going to write that in the corner of my screen. Bear with me because I'm writing on a slippery surface, so my writing may not be as neat as it is on the board. And for those of you that work with me in class, you know that sometimes my writing isn't perfect. But what we have here is the average cost. Oh, I don't want that. I want a pen. Average cost is equal to the total value of our purchases. So and since I'm talking about a value, this is expressed in terms of dollars divided by the number of units. So what I've done is I've gone ahead and I've taken the data that it's referencing, which from E6-2, and I've put it here. I'm going to highlight it a light orange. It seems appropriate because we're going to be referencing this data as we solve this problem. The very first transaction, it says May 1st, the balance, we have 5 units for a unit cost of $900. Well, this is just what our beginning inventory balance is. Remembering in the schedule, we have 3 broad columns, one for purchases. That's when we purchase inventory, we'll categorize it here. One for cost of goods sold, that's when we're selling item. We use this to calculate what our cost of goods sold journal entry would be. And then the inventory on hand column is for what is our balance sheet value as of a specific day. What do we currently have on hand? So going up to May 1st, this is what we currently have on hand. This is our beginning inventory balance. We currently have 5 units. The unit cost is 900, which means our inventory asset balance as of May 1st is $4,500. That's what we would be reporting as a current asset of inventory on our balance sheet as of May 1st. It's the prior period's ending balance. So you may be wondering, well, what the heck? I didn't have to do anything, and you're right. You didn't have to do anything in order to put this first line in. The unit cost here is what our average cost is. It was already calculated for us. So this, we're done now. We're done with this May 1st transaction. Moving forward to May 6th, we made a sale. Elmo's Music made a sale. They sold 3 units. Now, again, it's leaving unit cost blank. It does give us, at least in E6-2, what the selling price is, and the selling price was $1,600. But I don't need to know the revenue amount in order to calculate what the cost of goods sold is. The cost of goods sold with the moving weighted average method is driven by this formula multiplied by the number of units. If we sold 3 units, I'm going to categorize it under the cost of goods sold column. I should first populate what my date is. This is now May 6th. We sold 3 units. The unit cost is taken from the prior period's average unit cost, and in this case, that's $900. The total cost of goods sold for this transaction is going to be $2,700. That's our journal entry amount would be when we're lowering inventory on our balance sheet and we're recognizing an expense on the income statement. So for clarification, or just to drill that home, this $900 comes from the prior period's ending average unit cost. But to make this clean as I move forward, what I'm going to do is I'm going to erase this just so we have a clean sheet. This would be the journal entry amount, the debit to cost of goods sold. I want to know also, though, what my current balance is as of May 6th on the balance sheet. What is my existing inventory on hand? Well, before I had 5 units. I just sold 3 units. So now, of course, I'm going to have 2 units of inventory. And before, my asset balance was $4,500. I just sold $2,700 worth of it. So now, expressed in dollars, it's $1,800. I'm going to use these two figures to calculate what my weighted average cost is between these, and that's going to be the total value of my purchases. So we're looking up here. So looking up here, what's the value of my purchase? Well, right now, my value is $1,800. I'm going to divide that by the total number of units. What's the total number of units I have? Well, right now, as of May 6th, I have 2 units. So 1,800 divided by 2 units is 900 per unit. Now, you might be wondering, well, Kyle, the unit cost on May 1st was also $900. I just made a sale, and now my unit cost is $900 again. And you would be absolutely correct. I didn't actually need to calculate that with this because the unit cost, the average unit cost, doesn't update on sales. It only updates on purchases. However, I do think is a best practice to get into the habit of knowing and using this formula up here in order to calculate average cost. So now we're done. We're done with May 6th. We can go on to May 8th, and we made a purchase. So I'm going to start by just populating the date, May 8th. When we make a purchase, of course, we're going to categorize it in this purchases column. And what did we do? We bought 10 units at a unit cost of $840. So the total transaction amount is going to be these two multiplied together, so $8,400. So here, when I was talking about May 6th, I said the average unit cost doesn't update on sales. I said it does on purchases, and this is a perfect example. So before, we had 2 units. We added 10 units into our storage room. So now we have a total of 12 units. The total value of these purchases is going to be, well, what was the value before this purchase? We had $1,800 worth, and we added $8,400 in total value to our balance sheet. So our total value right now is $10,200. To get our average unit cost, I'm going to look at the formula that I've given myself up top, value of purchases divided by number of units. Well, the total value is 10,200, and I'm dividing that by 12 units. So now my average unit cost is $850. And this is what I'm going to use now if I make a sale to calculate what my cost of goods sold amount would be. And now we're done with the May 8th transaction. We're going to move forward with May 17th. So on May 17th, there was a sale of 4 units. Remembering when I'm making a sale, I'm categorizing it in the cost of goods sold column. So we sold 4 units. And this is where the average unit cost comes into play. We calculated on the prior date, on May 8th, our average unit cost of what we have currently in our storage room is $850. So we use that in calculating the total cost of goods sold amount of this transaction, which is totaling $3,400. So with this, what we would do is we would debit cost of goods sold by $3,400 and credit inventory by $3,400 because we no longer physically have those items in our inventory. It's no longer an asset to us. We need to update our balance sheet to reflect that we no longer have it. But I also want to know on May 17th, I want to know, what do we have on hand? What is our updated inventory balance? Well, in the prior period, we had 12 units, and then we got rid of 4. So now we have 8 units. Additionally, we had $10,200 worth of inventory. We sold $3,400 worth of it. If I use my formula, what is the value of our purchases divided by the quantity we have? It's going to be $850. Remember, our average unit cost shouldn't be updating when we make a sale. It only updates on purchases. However, I do think it is best practice to make sure we get comfortable with using this formula here. But that's it. We're done now with May 17th. Moving forward to May 30th, we made a purchase, or Elmo's Music, made a purchase of 5 units. So remember, purchases get categorized under the purchases column here. So 5 units. The average cost, or the cost of that purchase per unit, is $840. The total transaction amount is $4,200. To update our balance sheet, well, I know before we had 8 units, we just added 5. So it's going to be 13 units we have in our storage room. Before this transaction, our balance sheet value was $6,800. We just added $4,200 to it. So our balance sheet value now is $11,000. I'm going to use our formula to calculate what our average unit cost is. So we have $11,000 worth of inventory split between 13 units, yielding an average unit cost of $846.20. And that's it. We're done. We've done this problem now to completion. I'm just going to do a couple things that are important, mainly the totals. So just bear with me. I'm going to do a little bit of formatting. And well, throughout the period, we purchased 15 units. Our total value of our purchases was $12,600. We purchased 7 units, and our total cost of goods sold for the period is $6,100. So this is our, I guess, ending balances. If I were to put an ending balance of inventory, I'm not going to sum these columns. Why? Well, because the balance sheet is a snapshot in time. As of each of these dates, that's what our balance sheet amount is. So if May 30th is our ending balance, or end of the period, we have, as of May 30th, 13 units for a total cost of $11,000, and that $11,000 in value divided by 13 units gives us an average unit cost of our May 30th balance of $846. Now what I want to do, we've done this problem now to completion, but I want to take it a little bit further and go through a couple of journal entries just to help solidify what we've learned. So hopefully we can all recognize that this $6,100, this represents the total cost of goods sold for the period. That's the total cost of goods sold for the period, the $6,100. But what should have been happening, of course, with every business transaction, there's going to be a few journal entries associated with it. So I'm going to pick this May 17th transaction, and what we'll do is the journal entry specific for this one. So just bear with me while I get a journal entry template set up. It should come with a date. You need to know the account. Debit, credit. Now, if at this point in the course you're still weak with journal entries, you likely are still going to need to memorize how to do them. And a good way to do it is to set yourself up for success by giving yourself a cheat sheet. So a good way to remember is remembering DC Adler. I'm going to put this over here. D for debit, C for credit, so DC, and then Adler. So asset, draw, expense, liability, equity, revenue. Make this a little bit prettier. It's a little bit better. So what this shows is the normal balance for every account type. DC Adler, the normal balance for every account type. To increase an asset, I debit an asset. To increase a liability, I credit a liability. If I want to decrease any of them, I do the opposite of what is shown here. But on May 17th, we had a transaction. There was 4 units that were sold. So May 17th. Of course, when we're selling inventory on a perpetual inventory system, there's going to be 2 journal entries. I'm going to make an assumption here that the sale was on credit. So accounts receivable is going to be debited. The debit amount is going to be, if we look up here, we originally, the company records indicate the following for a particular line of guitars that sell for $1,600 each. That's the unit price. The revenue amount, 1,600 multiplied by 4 units that are sold. I'm debiting accounts receivable because accounts receivable is an asset account. To increase assets, I debit assets. Similarly, accounts receivable went up because we made a sale. It's going to be sales revenue. And I'm going to credit sales revenue by $6,400 because to increase revenue, I credit revenue. This is only half of the journal entry. The other half, of course, is to do the cost of goods sold transaction. So cost of goods sold is an expense. To increase expenses, I debit expenses. 3,400. I'm getting the 3,400 because that's what we calculated on May 17th as the amount of cost of goods sold. And this is what we're lowering inventory by. I'm going to credit inventory by $3,400. I'm crediting inventory because, well, it has a normal debit balance. So to increase inventory, I would debit inventory. But right now, we physically removed items from our storage room. I'm not increasing inventory. I want to decrease it. So I do the opposite of what's shown here. So I'm going to credit the asset account by $3,400. So gross profit, we know, net sales minus cost of goods sold. And in this example, that's going to be 6,400 minus 3,400 for a total gross profit of $3,000. But one more thing I want to point out, doing this cost of goods sold journal entry is very important for us because it satisfies an important principle of accounting, specifically known as the matching principle, where all expenses are matched to the revenues that they help support generate. So what we're doing when we treat inventory as an asset and then transfer it to the income statement as an expense when it's sold is we're matching these two together. This expense help support generate this revenue on May 17th. So let me clean this up for you a little bit here. And voila, we're done. So thank you for listening. Again, this was a tutorial on how to solve problem E6-4 from the workbook. If you have any questions, feel free to reach out to me or to any of us. We're here to help you through this process. And I hope you found this helpful. My name is Kyle. Thank you.